You know, we had the opportunity to help our dear customer start a retirement fund, and she started it several years ago. And since there wasn't a lump sum of money at that time, we were unable to do a lot other than start a monthly payment program and start depositing money into a mutual fund. And she's done that faithfully over the years, and now that she has accumulated a couple $1,000s, we're able to transfer that money to something like a fixed indexed annuity. And what would that do? It would literally guarantee that every dollar that goes into the account is always worth $1. You wouldn't be subject to market risk. Market risk is where somebody's in a mutual fund or a stock or a bond, and they paid any amount of money for the share, $10, $15, $20 for the share, and at some point in time it's worth more, and at another point in time it's worth less, just the way the stock market moves. And most of us are aware that the stock market's been volatile for the last couple of years, since 2008. Well, I was informed that her account grew by $1,500 last year, and she hasn't been able to deposit to it. So my comment has been, why don't we make sure that we guarantee that amount of money so that it will never retreat again, so that the amount of money that's in that account will always be worth that much and still get a chance at the upside of the market. So that the product that we use is from a life insurance company, and it's called a fixed indexed annuity. There are actually two types of annuities. One's called a variable annuity, in which my client is still in the market, but we could build a floor in on those. Those are for the more aggressive type investors, and that's something that we would do on a one-to-one basis. We would determine what their risk tolerance is. For those who really like safety or have a very low risk tolerance, sometimes we'll recommend the fixed indexed annuity because there's no market risk in them. There isn't quite as much opportunity for the upside of the market, but there is no downside of the market, which is really, really great. Most people don't plan to fail. They fail to plan. And my concept is that if I can convince my prospect, my client, to begin the process in their 20s, in their 30s, even in their 40s, it's never too late. But the more time we have, the more time we have an opportunity to have money compound over time. So what I would suggest in this particular case is examine both a fixed indexed annuity or maybe a variable annuity with a floor built into it. And that has to do with risk tolerance, and it has to do with some expenses. And so we work with people one-on-one to make sure that they have more than just Social Security to live on. It's an interesting fact that one of the members of my family did fail to plan, and he's unfortunately living on Social Security, and he's having to depend on his adult son to help contribute to make the house payment. He just failed to plan. And one of the things that we like to do in our agency on the financial services side is assist our clients who aren't aware that there are these type of products, and interview them and make sure that they understand what options are available out there in the financial markets.